Good day, fellow investors. We discussed how we are likely in a 42-year-old financial bubble, and therefore the only way to keep your wealth and allow for long-term compounding is value investing. And today I want to give you a value investing guide for 2025, covering the key value investing concepts and applying them onto a current environment. I have been value investing since 2002. It has completely changed my financial life because there are simply no other alternatives. And I'm happy to share my experiences here, so I hope you enjoy and smash that like button. Let's immediately start with the value investing framework and compare it to the S&P 500. As we said, the S&P 500 is in a bubble, and if you look at things, value investing, you look for businesses with 10% or more higher business yields. Current S&P 500 is 3%, deduct the buybacks that they are spending for too expensive stocks, and you get to a 2% business yield. Margin of safety, we look for essential things, structural trends like food, for example, that's cheap now. The S&P 500 high P ratio, no margin of safety. This is boring. Here and there somebody gets exciting about the stock, then you sell, but it's mostly dividends and you know what you will get. The S&P 500 is exciting, 40% up over the last year, and will be even more exciting when things revert, but you cannot know when. So 90% over the past 5 years, 40% over the last 12 months. And exactly because of this now, of this great performance, that's why it's time, in my opinion, to be a value investor for the next few decades, to avoid the risks inherent of stock market bubbles and allow for compounding. Because when I look at the S&P 500 over the long term, there are these periods of great booms like the 80s and the 90s, but then those are followed by very ugly periods where for 15 years you get nothing. That was the 2010s, adjusted for inflation till 2015. This is from 69, from the last period of exuberance prior to the dot-com bubble. People got nothing for 20-something years with downturns of 75% adjusted for inflation. Of course, 2029 stock market bubble, and then it took 30 years to recoup your gains just to get to zero. And I don't know what will happen next, but if what happened in the past happens again, like when the Dow Jones Industrial Average did zero from 1965 to 1982, which is a significant period of ups and downs, when, if you look at things, value here in the blue outperformed, and actually value gave you 12% per year in that period, growth 4% per year, and the Dow zero. And value investing outperforms because we simply look at things differently. For us, for value investors, the driver of investment returns are the owner's earnings, is the value created from the business. If we look at the current S&P 500 earnings yield, 3%, 3.25%, and it is at one of the lowest points in history. It has never been that low. The mean, historical mean, is 7%. And yes, when you add 3% growth on that 7%, that is the historical 10% that you got from the stock market. And that is a great return. But now the mean is 50% lower, which means long term you should likely be 5-6%, but that is the very, very long term. And the value creation is now much lower than it was. Again, the price you are paying is very high. If we look at the 10-year average price to earnings ratio, it is at 38, has been that high dot-com bubble and 1929 stock market bubble. The results after that we have already discussed, with huge crashes, 86%, 50% and more adjusted for inflation. So if the valuation reverts to the mean, it will get ugly. The current business dividend yield of the S&P 500 is 1.22. Compare it to the historical 4.2. We are at 30% of it, which is insanely low. And if this is just a period in history and we revert to the mean, then things might get ugly from that perspective. Not a prediction, just the risk explained. And then you think, if there is a bubble, if everything is so expensive, how can we value invest where the market is irrational? And here is a sneak peek of tomorrow's video. David Einhorn says that agricultural play is cheap, really pricey market as we just discussed, but there are opportunities where people are not watching. And where people are not watching because they are focused on AI, crypto, and whatever, is what puts food on your table, like tractors, harvesting, combines, etc., etc. And we'll discuss tomorrow how there is a cycle, and compared to the earnings, we now have a low P ratio, an even lower P ratio in good times, and then of course you don't make much in bad times, but that's across the cycle. Compare this company that we'll discuss tomorrow with the S&P 500, and you tell me what is most likely to give you 10% returns long term from a business perspective. I don't know what people will think about the market in the future. I don't care. I want to get my returns from business owners. This then is much cheaper. If your portfolio looks like this compared to this, what will be the difference? Because another key component of value investing is that it allows for compounding. And we have discussed how Goldman says that over the next 10 years, the market will give around 3% per year, which is still an exuberant projection because it comes from an investment bank and they are always exuberant. So when Goldman says 3% per year, it just tells you to not tell you this, that if interest rates just revert to the mean, that's a 50% crash for the market. If just it reverts to the mean. If it overshoots to the mean, that's something we don't even want to discuss here. And then that's the problem with compounding and risk. If we invest 100 and put it at 10% per year over 20 years, in 20 years you have 673. But if things change, just something changes in the environment. So 1960s, we have seen the stock performance. It was an environment of rising interest rates. This we are now is an environment of declining interest rates, a lot of money printing. Environments change. Even the Fed doesn't know what they will do. Now they are to gradual future interest rate cuts. 2 years ago they were at 2% or lower. They don't know. But if this happens just once in the next 10 years, your 10% compounding gets broken just once, let's say in year 7, that would be 2031 from when I'm making this video, you lose half of your, even more of your future wealth, which then destroys your compounding and doesn't make sense. Which leads us to the next component of value investing, avoiding risk. Asking yourself first, okay, what can go wrong? And if you don't like what can go wrong, then you simply don't do it. And that's exactly why Warren Buffett has now 325 billion in cash. He sold Apple to go into 3-month treasuries. When it comes to 3-month treasuries, Warren Buffett looks at it like this. What can go wrong? Maybe we can have higher inflation. Okay, then we have 4% inflation for a period. I get 4%, I make 0 in the worst case scenario from a real perspective return. Opportunity, what can go right? The market crashes, I get my money, I have my cash, and then I invest it into a great business at the fair price. So there is no risk for Buffett on this side, and all what's left is upside. Why did he sell Apple? Because the P ratio is a crazy 38. The dividend yield is 0.43. Compare that to the 4.5 treasury yield with no risk. And if Apple reverts to a P ratio of 20, and I have bought Apple in 2016 at a P ratio of 10 for the non-believers, that's 50% down. That's something that he doesn't want to give to Berkshire shareholders. And that's the essence of value investing. If something can go wrong that you don't like, you simply don't do it, no matter the chances of it happening or not. If there is such a probability, then you don't do it, you look for other opportunities, and you wait, like Buffett is doing. Before going into the search for value investments in this environment, let's define value investing. Value investing is usually defined as buying something below its intrinsic value. I have discussed intrinsic value a few times on this channel. You can check those videos or subscribe. I'll likely update also those videos, and then you can play around a little bit with intrinsic value. But I really want to elaborate on value investing, just separating from intrinsic value, which is just identifying the true value of a company based on fundamentals such as earnings, dividends, growth prospects, and the quality of management. You do that and you look for a margin of safety, discount to intrinsic value, so even if you're wrong that you can prevent unforeseen market downturns, all well, and you have a long-term perspective. You wait for the market to see the real value, and then when the market sees that, you make your gains. So that's one definition. The other definition is low price to book, low price earnings value, but that's more from 50 years ago. What I want to give you is a value investing process definition. So don't look at it like a singular moment in time, buying below intrinsic value. Look at it as a process. So basis, margin of safety, whatever happens, I am okay, as we discussed with Buffett's treasuries. Until you find the right opportunity, you wait for the right moment, and trust me, the market will give you the right opportunity, because the market is hoo-hoo and exuberant at one point in time, crazy at another point in time, as we'll discuss in a moment. And then you are being rewarded from owning the business, thus waiting. And that can be in dividends, in income yield like Buffett has in treasuries, in the businesses creating value for the future, even if that might not be shown in the profit and loss statement at that moment, because they are investing, building something, or who knows what. But if you own businesses, you enjoy the process of value creation. And then you put that into a comparative portfolio, process it over time, manage the position, lower the risks, and that for me is value investing. Of course, value investing is hard when you compare it to just putting your money in the S&P 500. But I think that at this moment in time, the hard value investing is much easier than the hardship that the S&P 500, the easy way investing, the passive investing, will be in the future if the things that are currently pushing the market higher revert. So let's go. Search for value. We have already discussed Einhorn. Food is now cheap. Oil is fairly priced, but might get cheap in the future. And then there is also Asia that is cheap compared to the developed world and compared to the 4.5 billion growing population and growing economies. So there is always places you can find value. But I want also to give you a time component to that search for value. Everyone wants, give me something below intrinsic value now that I can't lose money. Not that fast, Johnny boy. So if we go to my stock market research platform, I want to show you how I work on value. So I follow copper, some retail in Europe, Chinese stocks, food stocks, Berkshire Hathaway, iron ore, Brazil, Italian, Chinese, Asian, shipping, this is over, Asian, trading, fertilizer, telcos, mining, more shipping, paper, iron ore production, cash flows, etc., etc. And then there is more research than I do. And I watch these businesses and I patiently wait for the market to give me the right opportunity at the right price. On top of everything, I have analyzed more than 75 stocks this year just on YouTube, hundreds more on my research platform, hundreds more than you didn't even hear about because I had nothing to say about it. And that is the time component to wealth building. You follow and you patiently wait and you build your portfolio by adding at the moment in time when something is really cheap. And the more things you follow, the more opportunities you have. And therefore, I really want to pin down the value investing mindset that will help you, I think, anyone in the financial environment that is ahead of us. If something can go wrong, avoid it, don't do it. And what kind of value investing presentation would it be without Warren Buffett's quote, "The difference between successful people and really successful people is that really successful people say no to almost everything." And I say no to thousands of stocks a day, miss some opportunities, but we move only when it is a real value investment that helps us. And that is because the market is irrational and it will overshoot on the upside when it gets exuberant, but also overshoot on the downside when it is in panic mode. And to illustrate that, let's just look at the Nasdaq. How come that an index of stocks goes from 8,000, almost doubles in just 2 years, and then from the peak of 16,000 in again the following year it drops 34%? Have the businesses lost that much value only to regain 81% into the next 2 years? This is the market's irrationality, and you just patiently wait for those moments that come more often than you might think. Let's look again at Google. At some point the market is exuberant, then the market gets panicky and the stock is down 37%, only to rebound again 100% as the market follows. So nobody can tell me this is rational, and therefore there are where the market gives you the opportunities. And even discussing Google and the ups and downs, look at the net income. It is just growing, growing and growing. So no reason there, no drops in net income. The business just keeps on doing its business, growing and growing, but the market has its ups and down craziness. And therefore another component of the value investing mindset is having the patience and buying only when you like what you are buying. Remember, price is what you pay, value is what you get. And my rule is pretty simple. I want 10% or higher business yields across the cycle to minimize business risk. And then I am rewarded with this 10% of the business value creation, and then over time I hope to gain and compound value there with lower risk. For that, we have this value investment quadrant that represents the stocks that I have publicly analyzed on YouTube, and then you can see Berkshire, now a cash position, eliminated Apple, so medium return for very low risk because it's cash. Then we have food that is a little bit cheaper, we have retail that is cheap at the moment. We might discuss coal next week. Asia is also fairly priced, perhaps a little bit less risky than retail. Some in Europe have 6, 7, 8%. And then we have the exuberant part of the quadrant that is extremely expensive. Anything can happen, but risky. So that's the process of value investing, and the key is that you don't make it too complex. You buy good businesses that deliver good returns no matter what over the cycles. You just patiently wait. If you just add one of that business per year to your portfolio, in a decade you have an amazing portfolio. It's so simple. If it doesn't fit your investment goals, you simply don't do anything. There is always value somewhere because the market is crazy, and the value investing mindset applied the right way really changes your financial life over the long term, because you simply eliminate so much of the bad things that happens to irrational people. Thanks for watching. Check what I do, subscribe for more value investing, and I'll see you in the next video.